So I want you to imagine a massive, globally dominant record store.
Okay, I'm picturing it.
Right. And for years, they've been the absolute undisputed king of the neighborhood.
A go-to spot.
Exactly. But suddenly, management realizes this completely terrifying truth, which is that simply selling CDs, it just isn't enough to survive anymore.
Because the neighborhood itself has fundamentally changed.
Yeah, exactly. The whole landscape is different. So to stay alive, they decide they have to start building this sprawling live concert venue right in the back.
Oh, a full venue.
Yep. And at the same time, they're setting up this super premium exclusive merchandise stand in the front of the store.
Trying to monetize every inch of the place.
You got it. And the craziest part is they are doing all of this heavy construction while frantically trying to fend off a rival next door.
Right, the competitor.
Yeah, a competitor who is literally using algorithms to print infinite free imitation CDs and just, handing them out to people on the sidewalk.
That is quite the visual, but honestly, it's incredibly accurate.
It really is. And welcome to this Talk Tickers deep dive, by the way. Today, our mission is to strip away all that corporate fluff, look right past the Wall Street jargon and break down a truly fascinating first quarter 2026 earnings call from Tencent Music Entertainment, or TME.
Yeah, and it is a phenomenal case study for anyone who is watching the digital economy right now.
It really is.
For listeners who, might only know the parent company, Tencent, TME is just an absolute titan in the Chinese digital music space.
Well, a massive titan.
Yeah, they operate platforms like QQ Music, Kugou Music, WeSing. But, this Q1 2026 earnings report, it is far from a standard quarterly update.
Not even close.
Right. We are looking at a tech giant attempting to just completely redefine its fundamental business model in real time.
Under immense pressure, too.
Exactly, right in the absolute middle of the generative AI boom.
And for you, the listener, our goal today is to make this whole thing actionable.
Because that's what really matters.
Right. So whether you're currently holding TME stock, or, maybe you're considering a position, or even if you just want to understand where the creator economy is heading, we're going to look at the raw data.
We have to look at the math first.
Always. We'll uncover the hidden story driving those metrics and give you an opinionated bottom line on what it all means.
We want to figure out if this massive strategic pivot is actually working.
Or if the foundation is just, quietly cracking beneath them.
Right.
So before we get to the concert venues and the AI bots, let's establish the baseline. We got to bring those Q1 headline numbers to the table.
Let's hear the data. What exactly did Wall Street wake up to?
So total revenue growth for Q1 came in at a steady positive 7% year over year.
Okay, 7%. Not bad.
No, not bad at all. And digging into the components of that, their music-related services revenue, that jumped 12% year over year.
Wow, a 12% jump is significant.
Yeah, and membership services revenue specifically, that hit 4.6 billion RMB, which is also up about 7% from last year.
And just to give our listeners some quick context on that currency translation.
Oh, yeah, please do.
4.6 billion RMB is roughly 640 million US dollars.
Which is wild.
And that's just for a single quarter of membership fees.
Just one quarter. It's massive.
Yeah.
And then we get to the profitability metrics, which is where it gets really interesting.
The bottom line stuff.
Adjusted EBITDA was 2.8 billion RMB, so about 390 million US dollars.
Okay.
That is a very solid 10% jump year over year. And their gross margin, it actually ticked up by 0.8% to hit 44.9%.
See, that gross margin and that adjusted EBITDA number, that is where the real story begins here.
How so?
Well, adjusted EBITDA, earnings before interest, taxes, depreciation, and amortization.
The classic Wall Street metric.
Right. It's the standard metric analysts use to measure a company's core operating profitability. Yeah.
So when we see a company's total revenue growing at 7%, but their core operating profit is jumping by 10%.
It outpaces the revenue.
Exactly. And their gross margin is creeping right up toward that critical 45% threshold. It tells us something vital about their internal mechanics.
Like they're getting more efficient.
Yes. Exactly. It means TME isn't just, bringing in more money. They are structurally lowering their relative costs.
Right.
They are keeping more of every single RMB that flows through their ecosystem.
Which, I mean, that is the absolute ideal scenario for a mature tech company, isn't it?
Oh, absolutely.
Because, growth is important, obviously, but highly profitable, leveraged growth, that's what actually drives stock prices over the long haul.
It's the defining shift. It's how you go from being a scrappy growth stage tech company to a mature, predictable cash flow business.
Yeah, you grow up.
Right, because in earlier tech cycles, you'd routinely see these streaming platforms grow their top-line revenue by like 20 or 30%.
But they were just incinerating cash. Exactly. Bleeding cash to acquire those users, basically subsidizing the actual cost of the music just to get people in the door.
Right.
But TME is demonstrating real operational leverage here. A 44.9% gross margin in the music streaming business is notoriously difficult to pull off.
Because of the record labels, right?
Yes, the massive royalty payouts required by the major labels take such a huge bite out of revenue.
Right. So how are they hitting almost 45%?
Well, achieving that margin means they're either, negotiating much better licensing terms because of their sheer scale.
Which is possible?
Or they're significantly lowering their server and bandwidth costs. But more likely, they are successfully selling higher margin products to their existing user base.
Okay, so on the surface, that paints the picture of an incredibly healthy, highly optimized tech giant.
Very healthy.
But I'm going to play devil's advocate here. I want to push back on this rosy narrative a bit.
Okay, let's hear it.
Because if you dig just one layer deeper into the supplemental data of this earnings report, there is a glaring red flag.
You're talking about the social entertainment numbers.
I am. Social entertainment revenue. This segment dropped a staggering 9% year over year.
Yeah, that's a sharp drop.
Falling to 1.4 billion RMB, which is roughly 195 million US dollars.
That is definitely the metric that the bears tend to focus on, and honestly, for good reason.
It's a huge shift.
It represents a massive fundamental shift in their income distribution.
Right. And just for context for you listening, the social entertainment wing of TME primarily consists of their live streaming platforms and Weixin.
Right, Weixin.
Which is their wildly popular online karaoke app. And historically, these were the absolute cash cows of the company.
Oh, they minted money.
Users would go on these platforms, watch live streamers, or just, listen to amateur singers, and they would purchase virtual gifts.
The virtual tipping economy.
Exactly. Digital roses, custom animations, shiny VIP badges, all descend to these creators, and TME would just take a massive cut of those virtual transactions.
A huge percentage.
But now, this segment is down almost 10% in a single year.
Yeah.
So my question is, if their historical profit engine is shrinking that rapidly, are these positive headline numbers we just talked about simply masking a deteriorating core business?
That's the billion-dollar question.
Right. Like, are they just squeezing their loyal music subscribers with higher subscription fees to cover up the fact that the social entertainment model is actively decaying?
You are totally right to look closely at that 9% drop. But calling it a deteriorating core business, I think that ignores the broader macroeconomic and regulatory landscape in China right now.
How so? What's going on behind the scenes there?
Well, the decline in social entertainment isn't some sudden, shocking surprise to management. It's a managed transition.
A managed transition?
Yeah. Over the last few years, Chinese regulators have heavily cracked down on the virtual tipping economy.
Oh, really? I didn't realize it was a regulatory issue.
Oh, absolutely. They instituted strict daily spending limits. They completely banned minors from tipping live streamers.
Wow, that's a huge chunk of the user base.
Huge. And they introduced really strict real name verification processes. So the friction to spend money went way up.
Right. You can't just be anonymous and throw cash around anymore.
Exactly. And on top of all that regulatory pressure, TME is facing brutal structural competition for user attention from short-form video giants.
You're talking about Douyin.
Yes, Douyin, which is the Chinese version of TikTok. Douyin has just effectively monopolized the casual screen time that used to go toward things like online karaoke.
Yeah, people are just scrolling feeds instead of singing karaoke on their phones.
Exactly. So TME's management clearly recognized that the hypergrowth days of virtual tipping were permanently over.
The writing was on the wall.
It really was. So they aren't just squeezing existing users to hide a sinking ship. They are radically altering what the ship itself is designed to do.
And that pivot right there leads us directly to the first major strategic shift revealed in this call.
The fan economy.
Yes. To offset that structural decline in social entertainment, TME is aggressively moving into what analysts are calling the fan economy.
It's a fascinating pivot.
They are transitioning from being just a passive utility app, where you search for a song and hit play, into this immersive, gamified lifestyle brand for absolute superfans.
Going back to your intro, this is the record store building the concert venue in the back.
Exactly. And the data from the earnings call proves that this isn't just like an experimental side project for them.
No, it's becoming the core engine.
It is rapidly becoming the core driver of their growth. Management actually reported triple-digit year-over-year growth in their offline concert-related business and physical digital hybrid sales.
Triple-digit growth. That is incredible.
Right. When you see triple-digit growth for a company of this sheer size, it indicates they have found a massive, previously completely untapped reservoir of consumer demand.
They struck oil?
Pretty much. And to understand how this mechanism actually works in practice, we need to look at a specific case study that management highlighted on the call.
The Jay Chou project.
Yes, they partnered with Jay Chou for a project called Children of the Sun.
Yeah.
And for listeners who might be unfamiliar with the Asian music market, calling Jay Chou a superstar is a massive understatement.
Oh, completely. It doesn't do him justice.
He wields the cultural magnitude and the commercial power of like Taylor Swift combined with Michael Jackson in the Mandarin-speaking world.
He is an absolute cultural force.
So this wasn't just a standard digital album release where you just drop it on a Friday. It was a massive, multi-tiered commercial event.
It really was. The whole Children of the Sun campaign is basically a masterclass in modern music monetization.
Walk us through it. What did they actually do?
Well, they didn't just upload the audio files and cross their fingers that people streamed them. They engineered this bundled package that combined digital access with highly exclusive physical collectibles.
Like actual tangible merch.
Right. And then they gamified the purchasing process itself.
Oh, interesting. How did they gamify it?
They created digital leaderboards for the top buyers on the app.
Oh, wow. Tapping into that competitive fan energy.
Exactly. It drives the hardcore fans crazy in the best way possible. And they synchronized all of this with a massive nationwide offline marketing campaign across 45 different major cities in China.
That is just wild coordination. And the financial result of that single campaign is honestly staggering.
The numbers are insane.
TME reported over 1,000 million RMB in sales just from that one Children of the Sun package.
1 billion RMB from one project.
Yeah, that's roughly 140 million US dollars generated from a single artist's album launch.
It's hard to even wrap your head around that kind of conversion.
But here's the thing. Beyond the raw revenue, management explicitly noted that this campaign drove what they called meaningful as the VIP conversion.
That's VIP.
Yeah, which is their super VIP premium subscription tier.
Right.
So explain this to me. How does selling a physical collector's box actually translate into a recurring monthly software subscription?
It all works by creating a highly gated ecosystem.
Okay, a gated ecosystem.
Right. Think about the traditional Western streaming model, right? Spotify charges you, say, $10 a month, and you just get access to everything, period.
Yeah, it's pretty flat.
But TME is utilizing a really complex tiered approach. You can use the app for free with ads. You can pay a base subscription just for ad-free listening. But the SVIP tier, that is the golden ticket.
A VIP pass.
Exactly. If you wanted that limited edition physical vinyl of the Jay Chou album, or, if you wanted priority access to the pre-sale for his upcoming massive stadium tour.
You couldn't just buy it outright.
Nope. You absolutely had to be an active SVIP member first.
Oh, wow. That is incredibly smart.
It's brilliant. They are using highly desirable physical merchandise and real-world concert access as the hook.
To lock users into those high-margin recurring digital subscriptions.
Precisely.
And what's wild is they are systematically building the infrastructure to replicate this across their entire platform.
Yeah.
Not just for megastars like Jay Chou.
Right, they want to scale it.
The call detailed the launch of dedicated paid fan clubs. They just rolled out an inaugural club called Romance Universe with the artist Silence Wang.
Romance Universe, yeah.
And this isn't just, a free forum or a casual message board. It's a highly structured paid tier that offers fans priority ticket access, totally unique exclusive content, and these very artist-centric perks.
Furthermore, they're heavily investing in an app called Bubble.
Oh yeah, Bubble. I've heard of this.
Yeah, it facilitates direct, one-on-one style artist-to-fan communication.
like direct messaging.
Exactly, but behind a paywall. They recently brought on Tsuruki as their first Sony Music artist on the platform.
Thanks.
And they are aggressively integrating these massive K-pop acts, which, as we know, have notoriously dedicated and very high-spending fan bases.
Oh, K-pop fans will spend anything to support their groups.
Exactly. TME hosted flagship offline concerts for the K-pop group Baby Monster in Taiwan and for NCT Wish in Hong Kong.
Wow, so they're expanding geographically too.
Right. This is a highly deliberate strategy to position TME as the exclusive, totally unavoidable gatekeeper to these artists.
So essentially, if you are a fan, you really don't have a choice.
You really don't.
Like if you want the exclusive merchandise, if you want even a chance at getting front row tickets, or if you want to be in that private fan chat on the Bubble app.
You have to pay the toll.
Right. You have to operate entirely within TME's paid ecosystem.
Exactly. And this really highlights the fundamental difference in the economic models we're talking about here.
How so?
Well, the lifetime value of a superfan in this ecosystem is just exponentially higher than a standard listener.
Right. The math changes completely.
Think about it. A casual listener might generate, a few cents a month in ad revenue or maybe $5 in a base subscription.
Yeah, it's pennies.
But a superfan in TME's ecosystem, they might spend $100 on a limited edition physical box set.
Easily.
Then $200 on an offline concert ticket.
Right.
And $15 a month continuously, just for the SVIP tier to maintain their status and access.
So they're extracting hundreds of dollars a year from one person.
TME is effectively trading a high volume of really low margin users for a highly engaged, massively profitable cohort of superfans.
That is such a brilliant defense against the whole decline of their social entertainment wing. They're just replacing virtual tipping with tangible, physical, digital hybrid commerce.
Exactly. It's a pivot to real goods and real experiences.
But okay, this brings us to the second major narrative of the earnings call. And honestly, this is the part that shocked me the most as an investor reading through this.
The marketing expenses.
Yes, because if TME is successfully executing this super lucrative pivot to superfans, why did their selling and marketing expenses just absolutely skyrocket this quarter?
It was a massive jump.
Marketing expenses jumped 36% year over year in a single quarter.
Yeah.
Hitting 271 million RMB.
Yeah.
Which is about 38 million US dollars.
Just poof, gone to marketing.
Right. And in a corporate environment where they are supposedly tightening their belts and expanding their profit margins, suddenly throwing that much cash at marketing, it's a blaring siren.
It really is. It is the most critical pressure point in their entire operation right now.
So what's going on? Why the huge spend?
Well, management was unusually candid about what is actually driving this expense.
Which is rare for these calls.
Very rare. It is a direct defensive maneuver against competitors who are weaponizing generative AI to completely flood the digital music market.
They actually used a really specific, honestly, almost dystopian term on the call. They called it song washing.
Song washing, yeah.
Let's break down the mechanics of this because I think it's absolutely vital for investors to understand this technological threat. What exactly is song washing?
Right. To understand song washing, you really have to understand how generative AI is currently interacting with copyright law.
Okay, lay it out for us.
Let's say there is a massive classic pop hit that generates millions of streams a year for TME.
Like a guaranteed moneymaker.
Exactly. Aggressive rival platforms, and, management didn't name them explicitly, but we are definitely talking about heavily funded competitors in the Chinese digital space.
We can guess who they are.
Right. These rivals are using AI tools to analyze that hit song. The AI basically extracts the harmonic structure, the exact tempo, and the underlying melody.
Just ripping the DNA of the song.
Yes. And then it rapidly generates thousands of slightly altered permutations of it.
Thousands.
Thousands. It might shift the pitch slightly, apply a synthetic vocal track that was trained on royalty-free data, or just change the instrumentation just enough to evade automated Content ID copyright strikes.
Wow. So they are essentially creating thousands of quote-unquote legal knockoffs of popular music at near zero marginal cost.
Precisely. They don't have to pay human producers. They don't have to rent out studio time.
Or pay the artists.
Right. And because they alter the stems just enough to dodge the copyright filters, they don't have to pay those massive licensing fees to the major record labels.
That is wild.
So these rival platforms take this staggering influx of cheap, AI-generated content, and they just flood their own music libraries with it.
Just absolutely saturate the platform.
Exactly. And because the content costs them virtually nothing to produce, they can offer access to this massive library for free or at a wildly subsidized subscription rate.
Just to acquire users.
Yes, simply to acquire users and drive up their daily active user metrics.
In this technological loophole, it hits TME at a very, very specific vulnerability.
It does. Let's talk about the two apps.
Right, because TME operates a whole portfolio of different streaming apps, primarily QQ Music and Kugo Music.
Right.
Now, QQ Music has traditionally skewed toward a younger, more urban, premium demographic.
Tastemakers.
Exactly. Those users are very brand conscious.
Yeah.
They want the official J Chow track and high fidelity audio. They want the social status of having that little SVIP badge on their profile.
Right. They care about the authenticity.
But Kuga Music serves a vastly different demographic. It is a mass market app, historically really popular in lower tier cities across China.
And those users behave very differently.
Completely differently. Those users are heavily price sensitive. They often just want background music for their commute, or maybe a familiar melody playing in a shop, or just a certain vibe while they work.
Right. It's utilitarian.
Yes. To them, the subtle difference between the official track and the AI-generated knockoff, it really doesn't matter.
Especially if the AI version is completely free.
Exactly. If it sounds 90% similar and it costs $0, they're taking the free one.
And that is the exact dynamic playing out right now. These competitors are using this AI song washing strategy to aggressively divert traffic and steal those highly price-sensitive Kugo users.
It's a total raid on their user base.
It is. TME's management explicitly called this out on the call, actually stating that this behavior is, quote, an exhaustion of the economic value of this industry.
An exhaustion of the economic value. That is strong language for an earnings call.
It shows how seriously they're taking it. So, to stop the bleeding, TME had to make a really painful tactical choice.
What did they do?
They had to lower the barriers to entry on Kugo. They significantly expanded their free, ad-supported tiers to prevent those users from migrating to the rival platforms.
Okay, so they had to match the free offering.
Right. But when you offer your core product for free, your subscription revenue naturally stalls.
Yeah, people stop paying.
Exactly. So to ensure they were still acquiring high-value, paying users to balance out that massive free tier, they had to aggressively crank up their marketing spend by that 36%.
Oh, so they had to buy expensive traffic from other digital channels just to keep the funnel full.
You got it. They were forced into it.
Man, that is a brutal position for any company to be in.
Really brutal.
You're basically forced to heavily discount your own product just to maintain market share against an algorithm that produces infinite inventory for free.
It's a tough war to fight.
But TME isn't just, relying on throwing marketing dollars at the wall and hoping it sticks.
No, they have a structural advantage.
Right. The earnings call detailed a very specific structural defense mechanism they are deploying, and it relies heavily on their parent company, Tencent.
And this is where the sheer scale of the Tencent ecosystem becomes their ultimate competitive moat.
Yeah, tell us about the WeChat integration.
Right. On the call, management announced a significantly deepened strategic partnership with WeChat ads and WeChat channels.
Which is huge.
For listeners outside of China, it is honestly hard to overstate the dominance of WeChat.
It's not just an app.
No, it isn't just a messaging app. It is effectively the fundamental operating system of the Chinese internet.
You literally need a function.
You use it to chat, pay your bills, hail a cab, order food, and consume media. So the integration TME is building creates this totally frictionless funnel for user acquisition.
Let's break down the technical mechanics of that funnel. Like, why is this integration so much more powerful than, say, a standard digital ad on Instagram?
Okay, so think about a traditional digital advertising model in the West. If a streaming app wants to acquire a user, they place an ad on a platform like Facebook or YouTube, right?
Yeah, right.
The user sees the ad, they click the link, they get redirected to the App Store, they wait for the app to download.
Assuming they have good Wi-Fi.
Exactly. Then they have to create a new account, verify their email address, pull out their wallet to put in their credit card.
It takes forever.
Right. And then finally, they search for the song they initially heard in the ad. There is massive, massive friction at every single step of that process.
The drop-off rate has to be enormous.
It's staggering. But within the Tencent ecosystem, WeChat already has the user's identity, their entire social graph, and crucially, their WeChat Pay financial credentials securely stored.
Oh, so the wallet is already connected.
Exactly. So TME is leveraging WeChat Channels, which is Tencent's short-form video platform designed specifically to compete with Douyin. When a user is scrolling through short videos on WeChat and they hear a catchy song, there is a seamless native integration right there.
How does it work?
The user literally just taps a small icon on the video, and without ever leaving the WeChat ecosystem, the QQ Music mini program opens instantly.
Instantly. No app store.
No app store. The full, high-quality, fully licensed track just begins playing.
Wow.
And if the user wants to add it to their playlist or upgrade to SVIP right then and there, the transaction is processed instantly via WeChat Pay.
Just boom, done.
Often with just a quick facial recognition scan.
That is wild. It effectively bypasses the open internet entirely.
Completely bypasses it.
TME is utilizing Tencent's closed ecosystem to capture a user at the exact moment of musical discovery.
This moment of highest intent.
Right. And they're pulling them directly into the premium QQ music environment before the user ever has a chance to search for a free AI-generated alternative on a rival platform.
That's the key. You trap them in the premium experience instantly.
So they are willing to pay a premium to acquire these high-value users through WeChat because they know they're losing the bottom-tier, price-sensitive users on Kugou anyway.
Exactly. It is a fascinating strategic battlefield. You literally have premium, human-created, heavily licensed IP locked inside this massive closed social ecosystem on one side.
And on the other side?
On the other side, you have infinite, completely commoditized AI-generated content just flooding the open market.
Man, what a showdown. But this raises a huge question. If TME is spending 36% more on marketing to fight this algorithmic war and intentionally offering more free tiers to retain their price-sensitive users.
Yes, margins have to suffer, right?
Yeah. How is management possibly justifying this to panicked investors for the remainder of the year? Like, what is their guidance for Q2?
Well, management was starkly pragmatic. They didn't sugarcoat it.
What'd they say?
They explicitly warned Wall Street to expect short-term volatility. Specifically, they guided that Q2 revenue will likely be entirely flat compared to the same period last year.
Completely flat. Wow. In the growth-obsessed tech sector, telling investors that your revenue is going to be flat is usually a catalyst for a massive stock sell-off.
Oh, it absolutely can be, which is why the narrative they construct around that flat guidance is so incredibly crucial right now.
How are they spinning it?
They are essentially telling the market, please excuse the dust. We are fundamentally renovating the business.
Under construction.
Right. They are transparently acknowledging the structural pressures we've just discussed, the new physical merchandise and offline concert ventures, while they are incredible for brand loyalty and total revenue.
They're expensive to run.
Inherently, they operate on much, much lower gross margins than pure software distribution.
Because physical stuff costs real money.
Right. Manufacturing physical vinyl records, handling shipping logistics, and, renting out massive stadiums, that costs significantly more than simply transmitting data from a server.
Right, obviously.
Combine that with the intense subscriber competition from those AI platforms forcing higher marketing spend, and top-line revenue growth inevitably stalls.
Okay, so if top-line revenue is flat and marketing costs are elevated and they're expanding into these lower-margin physical goods, the math just doesn't seem to work.
It sounds like a disaster on paper.
Right, so how do they maintain that 10% growth in adjusted EBITDA we talked about? How do they actually protect their profitability while undergoing this massive renovation?
The answer lies in rigid, honestly, algorithmic cost control.
Okay, lay it out.
TME CFO Shirley Hu, she outlined the strategy very clearly on the call. First, they're going to dynamically adjust their channel spending.
Meaning what?
They communicated that the 36% marketing spike in Q1, that was a necessary tactical strike to stabilize their user base.
Just putting out a fire?
Exactly. They intend to pull that aggressive spending back and maintain a much more, quote, reasonable marketing growth rate for the rest of 2026.
Okay, so marketing costs come down.
Right. But the much more significant lever they are pulling is a ruthless reduction in what they categorize as low-value content.
Low-value content. Let's break down the mechanics of that.
Yeah.
What does cutting low-value content actually mean for a music streaming platform?
It requires a pretty deep dive into how streaming economics actually function behind the scenes.
Okay, take us there.
TME pays massive licensing fees to record labels based on a really complex formula of stream share and upfront guarantees.
Right.
Management is now utilizing their vast data analytics to evaluate the exact return on investment, or ROI, of every single catalog they license.
Oh, so they're scoring the catalog.
Exactly. If they identify a vast library of older niche tracks that cost them, say, millions in annual licensing fees but rarely ever get streamed.
They cut it.
Well, more importantly, if it doesn't drive new subscription signups or retain high-value SVIP users, they are simply going to let those licensing deals expire.
Wow.
They are aggressively trimming the long-tail fat from their servers.
So they're optimizing their inventory based strictly on engagement metrics, rather than just bragging about having the largest total number of songs.
Exactly. They don't care about having 80 million songs if 50 million of them never get played.
That makes total sense.
Yeah.
Protect the cash cow.
Furthermore, they noted a really significant tailwind regarding their operational costs. They are benefiting from reduced channel fees from the Apple App Store.
Oh, because of all the regulatory changes with Apple lately.
Right, and that reduction instantly flows directly to their bottom line, improving their gross margin.
Free money, basically.
Basically, they are systematically analyzing every operational corner of the business, from server efficiency to royalty negotiations to App Store taxes, and they're just squeezing out efficiencies to protect their core profitability while they weather this period of flat revenue growth.
Okay, I have to play the skeptic here again.
Go for it.
Because management is delivering a very, very polished narrative. They use these elegant phrases like leveraging their, quote, prosperous IP ecosystem.
It sounds great.
Right, and optimizing their WeChat integration to explain away a quarter of zero growth. But as an investor analyzing this data, I have to question if these ecosystem synergies are actually powerful enough to move the needle.
It's a fair question.
Like, is this just corporate speak designed to distract the market from the simple, terrifying fact that their core monthly active user growth for basic music streaming is just stalling out?
It is a totally critical question, and any seasoned investor should be inherently skeptical when a tech company blanks flat revenue on a strategic transition while pointing to vague synergies.
This is the oldest trick in the book.
It is. However, the data actually suggests that TME's prosperous IP ecosystem is not just vaporware in this case.
Really, you buy it?
I do, because the $140 million generated by that single J-Cho campaign, that is tangible, audited revenue.
That is real cash.
The sold-out K-pop stadium tours, those are tangible. They are attempting to pivot a massive, slow-moving corporate tanker ship.
Right.
What management is fundamentally arguing is this. Yes, we concede that we might lose 1 million casual listeners who just want free background noise to a rival AI platform.
Let them go.
But we are going to replace the economic value of those lost users by acquiring 100,000 superfans who are willing to spend 10 times as much money within our gated ecosystem.
So they are making a massive bet on the depth of the user relationship rather than the pure volume of users.
Precisely. And if we look at historical precedents in the broader entertainment industry, this transition is difficult, but it is highly lucrative if executed correctly.
Do you give an example?
Look at the global economic impact of Taylor Swift's Eras Tour.
Oh yeah, billions of dollars.
Or the sheer commercial dominance of K-pop merchandise globally. The fan economy is arguably the most resilient, inflation-proof sector of the modern music industry right now.
People will skip dinner to buy a concert ticket.
Exactly. And TME is building the exact digital and physical infrastructure required to capture that value exclusively within the Chinese market. So, while terms like ecosystem synergy often sound like total fluff, in this specific instance, it represents a very real existential strategic pivot.
High stakes, though.
Extremely high. If the fan economy trend cools down, or if Chinese consumers suddenly reject this whole model of bundling physical goods with digital access, TME is in deep, deep trouble.
But if the trend holds?
If the trend holds, their current pain is just the cost of building a massive, insurmountable competitive moat.
Okay, which perfectly sets up the ultimate question for our listeners.
The bottom line.
Right. We've analyzed the 7% revenue growth. We've broken down the economics of those crazy J-Chow superfan campaigns.
That physical-digital hybrid model.
Right. We've explored the technological threat of AI song washing, and we've dissected management's justification for a flat Q2. Now, it's time to synthesize this data into an actionable bottom line.
Let's do it.
If someone is holding TME stock right now, or, maybe looking at this earnings dip as a buying opportunity, what is the ultimate signal here? Lay out the landscape for us. Let's start with the safety net. What is the floor for this company?
Well, the financial floor for TME is remarkably solid, which significantly mitigates the downside risk for retail investors.
How solid?
Regardless of the existential threat posed by AI algorithms or the structural pain of transitioning their business model, TME is not some distressed asset fighting for its daily survival.
They aren't going bankrupt tomorrow.
Not even close. They are sitting on a staggering war chest of 41 billion RMB in cash equivalents, and short-term investments.
41 billion RMB. That translates to roughly $5.7 billion in pure liquidity.
It is a massive, massive buffer. And that level of liquidity gives their management team the ultimate luxury in the corporate world, which is time.
Time to figure it out.
Right. It gives them the runway to make mistakes, to test out new fan economy features, and to weather several quarters of flat revenue without ever facing insolvency.
And what are they doing with all that cash?
Crucially, they're not just hoarding this capital like a dragon, they are actively returning it to their shareholders.
Always a good sign.
During the call, they announced a payout of a 12-cent per ordinary share annual dividend.
Okay, solid.
Furthermore, they firmly reiterated their commitment to completing a massive 2-year stock repurchase program right on schedule.
Oh, buybacks?
Yes. When a board of directors is aggressively buying back its own stock on the open market and issuing consistent dividends, it provides a very real psychological and financial floor for the stock price.
Because it tells the market they believe in themselves.
It is a clear signal to institutional investors that management believes the stock is currently undervalued. And more importantly, that their underlying cash flow generation is totally secure despite the top-line volatility.
Okay, so the basement is heavily reinforced with cash. But, investors buy tech stocks for the ceiling, not the basement.
Fair point.
If I am evaluating this stock, give me the bearish argument first. What is the specific red flag in this data that tells me to deploy my capital elsewhere?
The bearish argument centers entirely on the vulnerability of their traditional top-of-funnel growth.
Okay.
For years, the dominant Wall Street investment thesis for TME was just that they were the Spotify of China.
Right, just a massive volume play.
Exactly. Institutional investors looked at TME's massive pool of hundreds of millions of monthly active users on their free tiers.
And just assumed they'd all eventually pay up.
Right. They assumed that over time, TME would inevitably convert a huge percentage of them into paying standard monthly subscribers, completely mirroring Spotify's success in the West.
But this Q1 earnings call kind of shatters that pure comparison, doesn't it?
It effectively shatters it.
Because the AI competitors have fundamentally altered the value of a casual stream.
Exactly. The data clearly indicates that TME is actively bleeding that price-sensitive, casual listening crowd to aggressive rivals leveraging AI song washing.
They're just losing that bottom tier.
Right. So if your personal investment thesis relies on TME adding millions of new low-tier $3 a month subscribers every single quarter in perpetuity, the data shows you are going to be severely disappointed.
It's just not going to happen.
The top of funnel growth for standard commoditized music streaming in China is hitting a brick wall. The market is highly saturated and competitors are entirely willing to give a good enough AI product away for free.
Which is terrifying for margins.
Yes. If TME fails to differentiate its premium offerings and gets dragged into a race to the bottom on pricing just to compete with server farms generating infinite covers, their gross margins will violently collapse. That is the fundamental bear case.
That is a highly credible, really scary threat. But let's flip the perspective. What is the bullish signal hidden in this earnings report? Why would a rational investor look at a flat Q2 guidance and decide this is actually a massive buying opportunity?
The bullish signal is that TME's management team has realized the Spotify of China model is ultimately flawed in the current technological environment.
They see the writing on the wall.
And they are successfully executing a pivot towards something significantly more lucrative, the absolute monopolization of superfan monetization.
Okay, elaborate on that.
If you believe in the continued exponential explosion of the Chinese live music boom,
Which is booming.
and if you understand the deep psychology and economics of the Asian fan economy, TME is arguably the best positioned company on earth to capitalize on it right now.
So they are basically transitioning from being a basic utility to becoming the toll booth for fandom itself.
That is the perfect way to phrase it. They are no longer simply charging a flat, boring monthly access fee for an audio file.
They want a piece of everything.
They are capturing revenue at every single stage of the economic life cycle of a fan.
Break down that life cycle for me.
Okay. The user buys the digital album on QQ Music.
Check.
Then they order the physical collectible box set through the integrated e-commerce portal.
Check.
Then they pay for the monthly SVIP tier just to secure priority access to the concert presale. Then they buy the actual stadium ticket through TME's ticketing partnerships.
Wow.
And finally, they pay a recurring fee to join the exclusive artist fan club on the Bubble app.
It never ends.
TME takes a high margin percentage at every single step of that journey.
That is wild.
If you believe that TME can continue to utilize Tencent's massive capital to lock down exclusive rights to top-tier IP-securing artists like Jay Chou, the biggest K-pop acts, and rising domestic stars, then the data shows they are executing this strategic pivot flawlessly.
They are intentionally trading a high volume of low-margin casual users for a much lower volume of massive-margin superfans.
Exactly. It all comes down to execution now.
So for the listeners who are really tracking this stock closely, what is the single most actionable metric they need to watch for in the upcoming Q2 earnings release? Like, what numbers will prove which side of this war is actually winning?
Focus entirely on their Q2 gross margins.
Just the margins.
Just the margins. Management has already telegraphed that total revenue will likely be flat. The market has already priced that in. But if top-line revenue is flat, and they still manage to keep their gross margins high, maintaining or even exceeding that 44 to 45% threshold.
What does that mean?
It is absolute proof that their strategy is working. It will prove that their rigid cost controls, their algorithmic trimming of low-value content, and their aggressive pivot to high-margin physical goods and SVIP tiers can successfully protect their profitability even when top-line growth stalls.
Wow. Okay. And on the flip side,
However, if those margins compress significantly in Q2, dropping back down towards, say, 40% or 39%,
then what?
it will indicate that the AI competition is inflicting much deeper financial pain than management admitted, forcing them into unprofitable discounting.
So the margins are the whole ball game.
If margins hold, the pivot is a success. If they drop, run.
That is the exact kind of actionable intelligence our listeners need. Watch the Q2 gross margins. Man, we have covered an immense amount of ground in this deep dive.
We really went everywhere.
We started with what appeared to be a pretty straightforward 7% revenue growth story.
Yeah.
And we broke down the mechanics to expose a massive 36% marketing spike driven by this defensive war against AI song washing.
That's a crazy story.
We detailed the fascinating economics of the Asian fan economy, illustrating how physical collectibles and those SVIP tiers are replacing the lost revenue from the virtual tipping crackdown.
Right.
And we analyze how TME is utilizing the sheer gravity of the WeChat ecosystem to build this closed, totally frictionless funnel to protect their premium IP.
It is a phenomenal corporate battle, truly. And it highlights a fundamental tension that extends far beyond the Chinese digital market or TME's stock price.
Well, for sure.
I actually want to leave our listeners with a final, slightly provocative thought inspired by the underlying themes of this entire earnings call.
Okay, let's hear it.
During the presentation, TME's management team took a very bold, honestly philosophical stance. They stated, and I'll quote this directly, "We are more convinced than ever that original human creativity and premium music IPs are the ultimate adventure."
The ultimate adventure, which is a very noble, very artist-centric stance for a major multi-billion-dollar music corporation to take publicly.
It is noble, and it obviously aligns perfectly with their business model of selling premium access to human superstars. They basically insisted that their massive investments are based on the belief that AI will only ever complement human creativity, not replace it.
Right.
But we have to ask if that is a realistic assessment of the future consumer.
What do you mean?
Well, if heavily funded competitors are already successfully stealing away millions of casual, everyday listeners using cheap AI-generated covers and algorithms and song washing.
That's what you're doing right now.
Right. We are forced to confront a highly uncomfortable question. Are we rapidly approaching a cultural inflection point where the average mass-market consumer simply does not care if a human being actually created the song they are listening to?
Wow.
right? Like if a user just wants a relaxing lo-fi beat to study to, or a high-energy electronic track for their workout at the gym, or a catchy 15-second hook for their short-form video feed.
Does the backstory even matter?
Exactly. Does the struggle and the humanity and the artistic intent of the artist matter to them at all in those moments? Or are they perfectly satisfied with an audio file generated in 3 seconds by a server farm?
And if the mass market decides that the AI-generated audio is, quote-unquote, good enough,
then the whole paradigm shifts. If the vast majority of consumption shifts toward algorithmic generation, then does TME's massive multi-billion-dollar investment in premium human IP actually become their greatest competitive strength, acting as this exclusive high-price sanctuary for true art?
or does it become an incredibly expensive, totally fatal liability in a market that has entirely commoditized music?
That is the ultimate question.
That is the multi-billion-dollar question underlying this entire transition. Are they flawlessly executing the construction of this beautiful premium concert venue in the back of their record store?
Right back to the analogy.
Only to discover that the entire neighborhood is perfectly content just standing out on the sidewalk listening to the free algorithms.
It's a scary thought.
It is something to seriously ponder the next time you put on your headphones and hit play on your favorite streaming app. Is the audio you are consuming the ultimate adventure of human creativity, or is it just a highly optimized algorithm?
Something to think about.
Definitely. Well, thank you so much for joining us on this deep dive. Until next time, keep looking past the headline numbers.